Welcome to the How to Buy or Sell a Business Successfully podcast. The concepts discussed in this podcast are for informational purposes only. No attorney-client relationship is intended or formed by this podcast. No legal advice is intended in the substance of this podcast. Feel free to check out our website, www.goforemanlaw.com. Enjoy the show and welcome your hosts, Jake Wayman and Sam Foreman. Welcome to How to Buy and Sell a Business Successfully. My name is Sam Foreman. I'm the founder of Foreman Law. Our firm focuses on mergers and acquisitions, ownership transitions, and business law. And one of the best things going on in my life right now is the use of technology has just continued to get better and better. I was having a Teams call at home last night while my 3-year-old was using his entire body and lung capacity to try to break through the door. And no one on the Teams call, at least this is what they tell me, heard anything. And so I'm grateful for technology today.
That's
also,
awesome.
I love my 3-year-old, even when he's a handful. But my co-host today is Jacob Wayman.
Thanks, Sam. Appreciate it. My name is Jake Wayman. My wife and I are the proud owners of Orange Theory Fitness here in Wichita, and also serve as a fractional business development executive for my consulting firm, Wayman Consulting Group. Work with the investment bank out of Oklahoma City, also my family's company, Citywide Facility Solutions, and dabble in a couple of different other things too as well. I wear a lot of hats because I'm bald, so I like to cover that up sometimes.
Whatever the reason, wear great hats.
Yeah. But best thing going on in my life right now is that it's the end of school year right now, and getting ready to be Memorial Day with when we're recording this episode, and we are about to embark on a 6-hour car ride to see my in-laws with 3 kids. So it's going to be an interesting car ride. We leave tomorrow morning, so
We'll pray for you, brother.
But yeah, anyways, we are joined with us today virtually by Pat Linden of Linden Law Partners. He's out of Denver, Colorado. He's a M&A transaction attorney out there. And if you don't follow him on LinkedIn, make sure you go follow him and put some great content out there. That's how we got connected with him. And so excited to have Pat join us. But Pat, I'll let you do an introduction.
Hey guys, thanks a lot for having me. Super appreciate it. I've connected and with Sam, followed Sam. He's been one of my tribe on LinkedIn, so it's awesome to be here. Looking forward to diving in on whatever you want to discuss today. I'll just kind of say, what am I happy about? I got 2 little girls, 7 and 8. I've been trying to get them into sports for forever. I'm an ex-athlete. They are just showed very little interest till recently, although one of my daughters has kind of shown an interest in track, and she did a 5K this last weekend. It was very cool.
Awesome.
And I have another, that's my 8-year-old. I've got a 7-year-old who somehow, some way has decided that she wants to get into horseback riding, which is not the least expensive endeavor that your kids could get in. I don't have any intention to buy a horse, but watching her do something she enjoys has been a lot of fun. So that's when I'm not working, they're kind of the lights of my life, and so I'm having a lot of fun with that.
Very cool. Well,
No, that's awesome.
Speaking of horses, I got to ask about Clint Eastwood. You got that right behind you.
Yeah, it's funny. So I'm a big, well, historically, I'm a huge Muhammad Ali fan in terms of kind of sports and just, champion of life type thing. Got a lot of other sports idols and all that, but Clint Eastwood is like my favorite actor, particular movie, Unforgiven. So I got this poster because I have this kind of eclectic blue office. What I'm sitting in right now is like my studio where we do a lot of content and all that. But I have this eclectic all blue office, and I needed a piece to round out an open thing. So I got this, and it's funny because everybody comments on it. So that's the history there. Big Clint Eastwood guy.
Very cool.
Very cool. Very cool. Well, thank you for joining us today. A couple of things we kind of wanted to touch on is, what are some tips and how do folks go from where they're at today to successfully preparing for a deal process, and then what do they need to be doing and thinking about to actually have a successful deal process and get it closed. And just kind of curious, more specifically, what's one kind of critical early move that you've seen that helps really increase the chances that somebody's actually even going to make it to a point where they can actually have an exit, as a potential seller?
If you see me looking down here and there, it's because I'm kind of getting old, and so I don't remember things as well as I can. But I've written content on literally all of these things. And so last night I was like, all right, what do I want to get into on some of the
Hmm.
particular areas?
Yeah.
So I want to make sure that I hit the pieces that I sort of jostled through. Um, yes, but to go back to your question, Sam. So there's a lot of different, as you're aware, being an M&A
Hmm.
company, there's a lot of different elements and could go in a lot of different directions. But for simplicity and practicality, here's kind of what I would say is, the first thing is you need to get your house in order, and that being your business, a couple years in advance, probably at a
Hmm.
minimum, you know, a full deal process typically. And this assumes, like, if I hired a broker or an investment banker today, and then they'd have to do a bunch of work, market it and so forth, probably get my books ready, do some other different things. Realistically, I mean, that's probably a year process. Fair enough, Sam? I
Hmm.
mean, it
Yeah,
was
sure.
really expedited and all the stars align. Maybe you could do it in 6 to 9 months, right?
Hmm.
And what that doesn't take into account is, how do you drive the valuation in the first instance? So
Hmm.
what I like to say is, think about staging it like you would a house. Now,
Hmm.
I don't like to compare selling a business to a house, except for this analogy, because like selling a business is like 1,000 times harder.
Yeah.
But one of the things that is
Hmm.
similar is, if you think about a house, in advance, there's data. If I paint the house, I do these certain things, I will get a disproportionate return, because a
Hmm.
buyer is going to want to come in and not have to commit the time and energy and money to doing some of those
Right.
things. So from a business standpoint, what does that mean? It means doing some of that investment maybe you didn't want to do before, because we know how hard it is to run a business
Hmm.
and everything in front of you at the moment. So, but making that investment, um, get your SEO right, get whatever it is that drives your business, get your sales team right, get your management team ready.
Hmm.
Hmm.
The business has got to be self-sustaining without you. And you want this, would to me would be a key. This would be the second point. So we talked about sort of getting the business staged, but get yourself quality of earnings ready.
Mm.
Or if not quality of earnings ready, mini quality of earnings ready. That can mean a lot of different things. Sam, you know the point, which is, get your books so that they can survive the scrutiny likely of a
Hmm.
professional buyer,
Hmm.
Yep.
particularly
Yeah.
private equity.
Yeah.
Yeah.
You're going to get deep into that, and there's going to be value eradication if you can't support that. So having
Yep.
that done well in advance is important. And the last thing is, you need to get your deal team ready, and you need a first-rate deal team. This is not something, it really doesn't matter if you're selling a business for $200,000 to $200 million. There'll be variance.
Hmm.
But you need to have people that have done this before. This is not like selling a house. You
Hmm.
don't want to just pull in your lawyer, which happens all the time, by the
Hmm.
way,
Yeah.
to review a purchase agreement like you think your realtor reviews your
Hmm.
housing purchase agreement. Though that is a different world. There's a lot more strategy involved here. Everything ultimately flows through the contracts, and there's a tight intertwinement between the financial and that, in terms of getting you the outcome that you want. So, um, get your house in order, get Q of E ready, get your deal team selected well before you go to market, in my view.
Yeah, I was actually, we're talking before this podcast. Actually, my team at Infinity Capital actually just threw out this article about Q of E and a sell side Q of E, and how much by you having that sell side Q of E ready to go when you're going through due diligence shows that you have things buttoned up, you're ready, you're here, and actually can increase the value of your company just based on doing that, because you're showing them, hey, I've done the work to make sure this company is ready for you to take on from a financial standpoint, because I have it in proof right here from a QV standpoint. So it's so important. It's such a, that term though too is so unknown amongst business owners though, and again, back to your deal team comment, it's like the people you need in your deal team are probably not the people that are in your company right now. You need your company to be well with your management team, but you may need to find a good, attorney, both of you, good CPA, good investment banker, all the different advisors for it, because that is so critical if you want to maximize the value of your company.
100%. There's another key thing that I think is worth articulating a little bit on that getting your house in order part.
Mm-hmm.
So as you guys know, here's the other element of that, because I run a business. I know that you have to pick and choose where you're going to allocate your money. I know how much time it takes um, just to do the day to day. And so it's nice in theory sometimes to sit back and go, well, you need to invest, you need to invest. Sometimes that's not completely realistic. Well, this is one of those scenarios that you really do need to be prepared to make an investment in. But here's the thing, you can get every dollar back in that investment in the form of a multiple. So
Yeah.
this investment, and what I'm referring to is the typical nomenclature is that most companies sell on the basis of EBITDA, a multiple of EBITDA. Not always the case. Some industries could be some level of revenue. If it's a SaaS company or a tech company, it's measured on annual recurring revenue. And you want to first understand what drives valuation in here. But the bottom line is that typically there's some multiple on that. So every dollar invested, if you do it right, you should be getting in spades on the back end.
Pat, I love that you addressed that. When when you encounter buyers or sellers for the first time, and it's their first deal, do you find that most people are coming at it from a perspective of, hey, this is sort of a semi commoditized process, and I just need to kind of go through the steps and run the checklist, but value is already sort of fixed in some sense? Or do you feel
Yeah.
like they come at it
Yeah. I
understanding that
mean,
you
if
can
I'm being
create
honest
value?
about it, I think 90% of the people that I deal with, come at it as a value commodity. They believe it's a commodity all the way around, right? Whether from hiring their broker to their attorney. And most
Right.
of the time they've gotten themselves far too down the road that they actually did sort of commoditize it for themselves
Yeah.
in an area that is completely non-commoditizable.
Yeah.
Let me give an example on that. Attorney who has a qualification to review a purchase agreement. Commodities. If I have my law degree, even if I am a criminal defense attorney, I have a license to review a purchase agreement. And that stuff happens. You'd be shocked how many business owners believe in particular the legal is commoditized. And I'll kind of circle back to why it's not commoditized and why there's real value lost by
Right.
treating it that way. But the other things that are truly commoditized, as we know, we form a company and that's commoditized. You
Right.
get an EIN, whatever. This is so brokers, and I'm going to throw some brokers under the bus here a little bit. A lot of folks in the financial realm and this whole process, they actually do want to commoditize everything. And the reason why they want to commoditize it is it's human nature. I'd probably be the same way if I was in certain roles within transactions, because yes, they want to see the buyer get a good outcome. Don't get me wrong, but have you ever met a real estate agent that wasn't to a degree self-interested in the commission at the end? Well, of course not. So the more that certain people can control the outcome. They can commoditize an attorney or whatever the case is. That can sometimes lead to an outcome, but it won't necessarily lead to the best outcome. And let me give you an example of that. So if you're talking about what I do, which is like lower middle market or middle market transactions where you're moving $100 million, $50 million, $25 million, whatever the case is. If I'm not on the front end, or you don't have somebody like me on the front end, Sam, you know this because we write about this stuff on LinkedIn all the time. Somebody just trots in, or you have somebody like me representing a buyer, because at the end of the day, don't get me wrong, I try to be completely transparent, but this is essentially about getting the right outcome for your client. Fair?
Mm-hmm. Yep.
The way that I'm going to approach it with a buyer is going to be markedly different than I probably am going to be with seller. With a buyer, I'm probably going to go, let's get in, let's do a generic letter of intent. These people are not going to be prepared to spend the money in the fashion that you can spend the money. We don't have the same level of sophistication. We don't have to give all the information. That's not, by the way, being unethical or whatever. That's just the way that the game is played and has been played since the beginning of time, right? And so then what you might, so let's give an example. Let's say the purchase price is 20 million bucks. What a lot of people are not going to tell you on the front end, if you're not properly advised, is you're not just getting that 20 million bucks and then retiring and going and hanging out on, riding off into the sunset. Most of the time, probably going to hold back a couple $1,000,000 of some sort. Probably in a lot of instances going to have an earnout. Probably going to have some rollover equity where you're going to have to do a lot of work to validate that the value is there. If I trade $3 million of my value for your securities, I got to do that work, right? Probably going to have some sort of tie in a lot of cases to a post-closing employment situation where they're not going to volunteer to you if we get rid of you. And that happens frequently at some point in time in these sales. We can either take your rollover equity back at a discount or whatever. So what is that advice worth? What is that advice worth to come in on the front end and run to ground those kinds of things? And at a minimum, that you thought you had a $25 million deal, but you really have a $17 million deal.
Mm-hmm.
Does that matter to you?
If you're lucky.
Most of the time, that's going to matter.
Yeah.
Secondly, then you're going to take the proactive steps to address that versus coming into it cold and then trying to undo that when you're in the process. Now, unfortunately, with a lot of first-time sellers, they go about this like I described in the first path. So hopefully that in some way says this is not about commoditization, because that M&A attorney or that business broker who just came out of corporate America and thought it'd be cool to come in and talk about buying and selling companies, they're not bringing that. The only way you can bring that is to have gotten kicked in the teeth and see how all of this works. So that to me is why it's so important to figure out your deal team on the front end and really kick a lot of tires.
Right.
Because not everybody's created equal. Really get people that are on your side that really understand how the other side's going to think about it and are going to advise you strategically.
Yeah. I think, go ahead, Jacob.
I was going to say, because I commend you for doing that, because even the organization that I work with, we focus a lot on lower middle market companies, because private equity is coming down market quite a bit now, and they are very professional buyers of companies. And so they're going to do whatever they can to get the best deal they can for them as the buyer. But the seller is, they don't know what they're leaving on the table. Because they're not knowledgeable. And so it's educating more and more folks that are in that space. And much like what you and Sam are doing, and along with this podcast, is just giving them more, tools in our toolbox so they know to call Pat or call Sam or call myself when it comes time to do that, so they can properly begin to think, so they can, get that $23 million versus the $17 million, and make sure they get the right deal structure there, so they get better, more cash up front. They get a better deal terms, those sort of things, because $23 million and the private equity is $23 million are not the same things many times.
Well, and let's talk about the fact that in most lower middle market deals, and that's exactly right, and you know this, it is a partnership. I mean, the in the space that we're in, there can be different with private equity if they've got platform companies and they have the management to come in and all that. But
Yeah.
just talking about your run of the mill 20 or $30 million deal, that's typically not the case. They're not in the business of operating
Yeah.
necessarily. They're in the business of helping you grow and then achieving that second bite at the apple, which can be incredibly lucrative, by the way, if you do it right. The problem is people have these discussions and they go, okay, yeah, it's going to be $22 million in cash at closing, which is not actually accurate because, as you know, Sam, at a minimum, probably going to hold back 10% or more on
Yep.
lower middle market deals. So you're really going to walk at closing with 20. You should get that 2 million later, but there's no assurance of that. And then you're going to roll $8 million, and it's awesome because we're private equity. We make a ton of money. That sounds cool. That sounds sexy. They all, most private equity folks want a 3x return in a 3 to 5 year period. But what that front end conversation is going to miss all of the particulars, which is that typically you're not going to be on the same level of the waterfall as them. They're probably going to get a preference unless you nail that down. Probably going to be some expectation tied to you being around. You may not want to be around for 3 to 5 years or whatever. So knowing those kinds of things gives you the ability to go, look, I get it. I get you want me to have skin in the game, private equity investor. I would want the same thing, do want the same thing for my PE clients and so forth. But what you have to then kind of traverse is to go, well, maybe I'd like to get 26 million in cash and roll a little less or whatever, really understand those dynamics. But unfortunately, a lot of times people trot in and they're not really having that discussion on the 8 million and how that's really, and literally sometimes it's a week or so before the closing. I mean, it's mind-boggling
Yeah.
to me that people do that. So, and
Right.
then certain advisors will not want to bring that up because they want the deal to just keep going and going and go. Again, self-interest,
Right.
right?
Right.
But they'll get paid on the 30 million. An investment banker or broker, a lot of times they'll get paid on the 30 million. So shouldn't we be talking about that 8 million that's still running amok beforehand, right? That's the kind of what my philosophy is. And I think as a founder, the best thing you can do is get educated on things like this, understand when to push early and when not to. And there are certainly things that you want, there are certainly things you need to get into the deal and you need to vet and you can't address up front, whatever. I'm not suggesting that. You certainly have to have that arsenal of information because I promise you a sophisticated buyer has it.
Well, it's something I want to kind of lean into is this kind of one of the questions in here is like, what other common misconceptions do sellers have when they first begin about exiting their business? I mean, it's probably many of the, the sellers that we're interacting with, it's probably maybe one of the first and only times they're going to transact a business. It's life changing for them. It's their life's work they're doing. So, it's very important. But again, to your point is they wait till the last week to talk about something very, very important. So, what other misconceptions do you run into with sellers when they're thinking about starting to sell their business?
The lack of planning, we talked about that in
Mm-hmm.
some fashion. I think thinking in some way it's kind of like a real estate transaction and it's really not. Um, I think the other misconception is that a buyer is going to pay you for potential that you've created.
Mm.
You've set the foundation and therefore, oh my gosh, if you come in and you throw some more money at X, Y, and Z, you hire, the next level of people that we need to have, you throw some more money in marketing and R&D and all that, this is going to be incredible. They're not going to pay you for that.
Right. Right.
Um,
Yeah.
you might get paid for that, and it's like this. you might get paid a little bit more. I'll draw the real estate analogy, even though I don't want to draw it, but real estate is very efficient, basically, at the end of the day. Price per square foot,
Hmm.
location, Zillow. I mean, even Zillow with its errors is within, I think statistically is within 5% typically
Mm-hmm.
what the sale price is. That is not the case when it comes to selling your business. There is, if you think about from a kind of a commoditized market, that being real estate, there might be a little bit of a bump. For example, if you've done that um, fix up work that we were talking about a little bit, yeah, like if there's two houses of the same square footage next door to one another, the house where they've done remodeling and stuff should garner some more money or whatever the case is, but it's not going to be like a 50% type kind of thing, right? When it comes to selling your business, you have to remember, I mean, at the end of the day, a buyer, of course, sees opportunity, of course, sees where they can better systematize. That's the whole point. They've got to make an investment and then they've got to try to get a substantial return on that investment. But let's not forget, unless you are like that unicorn IP company that we all hear about that hasn't generated a dime of income and then gets bought by Google
Yeah.
for billions of dollars. Okay. And
Yeah.
I hear about them, you hear about them. I haven't seen any. And personally, I haven't been
Hmm.
lucky enough to work on any of those in my day. So typically, there is a very important component, and that component is cash flow.
Hmm.
So, understand that when it comes to buying and selling businesses, for the most part, there is a component, which is what is your cash, whether it's above the line or below the line. And they're not going to pay you, they're already paying you to a degree for potential. So that is something that I think a lot of sellers get wrong, and they come into it and they're a little too greedy, or their
Hmm.
expectations are a little bit too high. And what the buyer is going to tell you is like, hey, if you think it's really worth that, then you should have made the investment to get it to
Yeah.
that
Yeah.
point. So I think
Yeah.
Yeah.
it's got
And
to be that balance. That's another
yeah.
misconception that sellers would have.
Yeah. I think that's so good. I mean, in our firm, we talk a lot to folks about understanding the transferability of value and really thinking really hard on that. Because at the end of the day, whether we're on the sell side or the buy side, we want people to know that price, at least if you're dealing with people that have some idea what they're doing in the process, is more dictated by the value that the buyer actually receives than the value that the seller gave up. And, all of those hypotheticals require adding value to the equation that doesn't exist yet. Like all of those what if scenarios about what could happen in the future require things to occur and value to be injected that hasn't been done yet. And so maybe that, like you said, that gets factored into, what trajectory is the business on. But a lot of that's going to be borne out by the financials as well, the historical data or what your sales pipeline looks like. But it doesn't exist yet today. And I mean, for buyers that are looking at businesses, you got to be really careful not to get caught in the trap of, that big dream that the seller has that just hasn't been done yet. Cause you should always be asking, like, hey, why isn't that done yet? Like, if it's so great, like, why haven't you doubled the size of your business? Why haven't you done those things? And because if it was that easy, then like you go do it and then I'll come back and I'll pay you for it because I'll be able to raise the money from a bank or from an investor to be able to come up with that value.
100%.
But I think it reinforces your point earlier about, just how if you want to describe it this way, how front loaded the value creation is in the deal process. You've written very well a number of times on the importance of the LOI and what has to go into it. And I think one of the things that is both an opportunity and frustration is how people approach that, where they're not thinking about, whether it's practitioners. Practitioners drive me crazy when they wait till the last minute to do the hard work. Um, but when the stage isn't set right, when the structuring doesn't happen early on, there's just huge amounts of value that get left on the table. And it's one thing if you're missing a couple hundred grand on a deal that's 50 to 100 million. It's another if this is your family's legacy. And, that's the difference between, having a nice amount to leave for your family and being able to kind of transform their legacy with what you're able to do. And, yeah, it's just that front end part of the process is where having your team and having the right team can matter so much, and doing it far enough in advance to, be able to do something with the information. Because if somebody comes to you, Pat, and says, "Hey, I've got to sell. Like, I've got a diagnosis, I've got a family thing coming up. I just can't stick around any longer. I must sell within the next year." You know, how much value are they going to get out of the advice that you and others deliver in terms of how to change the valuation of their business at sale time?
That's a great question. So, um, here's the thing. Even somebody who wants to do a fire sale
Mm-hmm.
has some limits on what the fire sale's got to be, right?
Right.
Fire sale can't just be free.
Yeah.
That's then you should just have a U-Haul come pick up all your stuff, whatever. But if the fire sale is, I've got to sell this and get a couple $1 million out of it or whatever,
Right.
well, that's still every deal is hard. Even if it's I'm giving this away to fire sale, then somebody's going to try and get it at below fire sale value. So you have to, I think the art of it, and this is really important. I mean, you know, starting a business like a lot of the folks that I work with is about 1,000 times harder. Whatever they figure out in terms of scale, and like HVAC companies I represented, where these guys are like HVAC guys, and somehow they create something and sell it for $35 million. Or I could
Mm-hmm.
never, right? To me, that is like so much harder than anything I do. But you know what I do know though, and this isn't saying, it's not a function of being smarter than anybody or whatever. It's a function of time and experience. I probably have 100,000 hours over my career of sifting through dense value transfer eradication scenarios,
Mm-hmm.
seeing people negotiate in every single fashion, and kind of able to put a probability on push back here, don't push back here, whatever. So even going back to that fire sale situation, you have to have adequate time. First, you got to have somebody who understands your objectives. And if
Mm-hmm.
you're doing a fire sale, the objectives are different than if you have 30 different suitors and you want to sell between 500 and $1 billion, right?
Mm-hmm.
But to just go to that fire sale situation, I still have to understand what are the key points, still have to understand how we at a minimum get that kind of the minimum amount, and then the mechanics to make it happen, and then all of the negotiating and the maneuvering and everything that's going to go with it. Because to get to that end number, no matter what it is, or end scenario, or all of the
Right.
above, you don't just sit down. I think this is a misconception for a lot of founders, and I hope they pay attention, because I am totally the kind of person that wants to make a deal once I have something in my mind immediately. I think, okay, I understand, I want this, let's just sit down, let's hammer it out. I think a lot of founders are that way too. These scenarios we're talking about, that is not the way that it goes in real life. You have to temper yourself, and you have to play the game. And you have to have somebody who is going to coach you through that game, be able to see ahead. So no matter what you're doing, no matter how simple you think what you're doing is, if it was that simple, for one, you wouldn't be looking to an advisor. So I think it's to me, Sam, it's all kind of the same, right?
Mm.
Like there's
Yeah.
challenges in really small deals for those reasons, and really big deals. And so the guy that has to sell immediately because he's got a heart condition or whatever, you got to figure it out. You got to do it quickly, but you
Right.
still have to
Right.
process the information and how to get to the right outcome in the same way as you would any other transaction.
Right.
Jake and Sam here.
Thank you for joining us. If you find this content helpful, please like, subscribe, share it with a friend, and especially leave us a 5-star review on Spotify or iTunes. Really helps us out a lot.
Yeah, 1 star, it's on Sam.
Yeah, it's definitely on me. Yeah, I would just echo that. I mean, I think that's very consistent with my experience, is that, on each of these deals, regardless of the constraints, they're hugely value creative exercises. And when people really come at it with that mindset, there's so much that can be achieved through them, versus just sort of like we talked about earlier, the commoditized approach. But time is just an incredible, multiplier of value. And you go to somebody like Pat early enough in the process and not under like a, heavy time constraint. And you say, hey, I really want to be here. I know I'm not there yet. How do I get there? And somebody like Pat helps you, develop those right deal team relationships and think about how to move the levers around that a buyer is really going to care about. I mean, you go from, having a significant amount of value delivered through a normal, through a time constrained process, if you will, to, being able to just completely change the outcome. Because there's some of those value pieces that a buyer cares about that you can't move around within, 6 to 12 months. I mean, they just take too long. If you've got really heavy customer concentration, if you don't have any long-term contracts, if your, cost structure, if your EBITDA isn't optimized for what a buyer really cares about, some of that stuff just it moves too slowly to have a significant impact, and then all you're trying to do is get a little bit of an extra bump based on what the buyer can achieve with a little bit more time, what you've positioned them for, but it's never going to be the same as if you had created the value yourself.
I think everybody also underestimates time, and it's
Mm.
fascinating from a human nature standpoint, because if you think about when we get our taxes done, we all know
Yep.
that our accountants crunch our taxes through a software program. Unless you're a massive business, they can do it very quickly and all that. But what I think a lot of people forget is that the tax provider's got probably hundreds of clients,
Mm-hmm.
right? I know that happens in my business all the time. Someone comes in with something they think is easy, and it's like, A, it's probably not that easy, but even if it was easy, I've got like 50 other people
Mm-hmm.
with the same thing. So there's only so much time in a day. And if you think about a business initiative, especially leading up to something like a life-changing business sale, like you guys' podcast, this is awesome. You're set up. But I'll bet it took some time. You didn't just dream this up and then not have to take some time to implement it. So if you
Mm-hmm.
take that on a much larger scale, I think we all have to be honest with ourselves. About a year, it goes like that,
Yeah.
right?
Yeah.
So that's why when people go, how long does it take to, well, a minimum a year to prepare, and they kind of
Right.
scoff at you or whatever, it's like, I'm being generous with you.
Yeah.
If you want to maximize the outcome, because you really should be thinking about it and investing in it far before that.
Right. Right.
If you want a $10 million plus outcome, that even $10 million, which is not in the scheme of it, it's not what $10 million was 20 years ago or whatever, but it's
Mm-hmm.
still, I promise you, when you get through the talk, nobody is just going to write you that check for $10 million without putting you through a process. And then the other thing that I should have mentioned earlier, speaking of processes, the other thing that I think you want to have as a founder is you want to have some degree of leverage. Leverage is
Mm.
optionality, and
Yeah.
run a process. Even if it's a small business, super small, run a process, get a broker, banker, whatever to drive the terms for you. Don't be that one person where you get an unsolicited offer and
Right.
think that that's going to be your best offer. That's not going to be the case.
Right.
So try to manufacture as much leverage for yourself through a competitive process as you
Yeah.
can.
Yeah.
Yeah. It's so hard to get your client a better outcome during the deal process when you lose your ability to say no, and the other party knows it. Like when you're in that position, and smart, buyers, smart sellers, they're going to know. I mean, they're going to know when you've lost the ability to say no because of the position that you're in.
Yeah.
And it's tough. They're competing against, in some cases, the alternative of you not having any deal to do at all.
Mm-hmm.
And that's a lot of leverage for, for folks to have. And so you give yourself time, you give yourself options, you give yourself team, you give yourself options.
Yeah.
Those are really good thoughts.
One, and so many times it's like talking about you're creating a competitive marketplace. I mean, going back to, your house analogy, I mean, realtors are trying to, help you drive value for the home that you've built. And, they're going to have people come look at the open house, those sort of things. And it becomes a bidding war. and you want it to become one as a seller, because that's going to drive maximum value. And if you, and so say you get that unsolicited, LOI coming through the door from a private equity group, it's like, hey, let me involve my attorney Pat, or my attorney Sam, or my investment banker Jake, or something like that. Now it shows them that, hey, I'm a professional business. I'm going to be here to work with you, and then that actually almost creates a better relationship with the buyer if you bring your team with you alongside you to say, hey, we're bringing more value to this, so like let's work out a deal here. And so I think that actually creates a much more better transaction when you have more people involved and you bring that professional side with you when you come alongside it.
1,000%. Now, the reality is most people listening, and I'm just trying to say to people listening, because this is the flat out case. That is so true. They're not going to believe it. They're going to go, I want to save some money. I can,
Yeah.
and listen, it's important to be incredibly prudent with your money. I'm not suggesting that but for example, you will pay me a lot more money if you hire me and you come to me with something where you got no good guidance on the front end. I promise you it'll be 5x. In fact, I might not even take your deal at that point. I'm at a point where I pretty much don't want to get into, I will, but it's got to be the right client. For the most part, I don't really want to be involved unless I'm involved at the front end.
Yeah.
Because these processes they're not just hard for sellers, they're hard for your advisors. When we try to do, call it 5 to 6 deals a year that are between 20 and $100 million. And then we do a bunch of, call it smaller stuff or whatever. But I will tell you, those 5 or 6 things really drive the economics of our firm and all that, but we earn it. That period is stressful because I've got to make some calculated moves and do some things and push you in a way you're not going to push yourself, that I know is going to matter. Going to matter to your bottom line. It's going to matter to your happiness, especially if you partner with like a PE group and kind of setting the table and all that.
Right.
So the point is, you are just leaving so much money on the table by going, I'm going to save money and I'm going to bring in an attorney at the end. When people say that, and I get it, because if I wasn't in this business, I would look at it differently. I'd go, well, I don't want to spend money. But I'm telling you, when people have that proclivity now, it just means they're not sophisticated. And for the most part, buyers are sophisticated. Now, you want the right person. I'm not saying just talk to Pat or whatever. Talk to Pat and Sam and one other person, and get people, Jacob, get people that you're going to pay them money. You're probably going to pay them well. But I'll tell you what, there is nothing in life or business like having a financial advocate, a legal advocate, a market advocate. We all know as small business owners how hard it is to find those kind of people.
Right.
That is what you need when it comes to this.
Yeah.
And people who are honest, by the way.
Yeah.
People that go, look, a lot of times people go, Pat, well, what's your fee going to be? Well, unfortunately, that kind of depends on how difficult the other side is, depends on how organized you are or not. But here's what I can tell you. I can tell you that if we get to something where I'm feeling it's going to go off the tracks or whatever, I am your partner in the deal. And I assure you, I'm going to give you a heads up on that. So no matter what the situation is, you're going to be in charge. You're going to understand your spend or not. And I'm going to be your partner in the transaction. I think for us, we've lost business that way because people wanted to hear us give a lower number, and there were plenty of people willing to do it.
Yeah.
In the end, we've gotten a lot of business because of that integrity factor. And I think, Sam, I'd love to hear both of you guys speak to that. I think that's something you make sure you want to, somebody who's going to, when sometimes you get the cost from people, You may not want to hear it,
Right.
but listen to the whole,
Right.
listen to the whole cycle
Yeah.
up, right?
Yeah. I think so. I'll answer that real quickly, and then Jacob, would love to hear your thoughts on that as well. I mean, I think I spent a lot of the early part of my career feeling huge amounts of pressure to make people happy and give them the answers I thought they wanted to hear. And then through the course of just a lot of sometimes very painful learning, learned that I didn't like the constraints that setting expectations based on way too limited information put on me and put on the client, and learned at some point that especially when it comes to these once in a lifetime transactions, is that these are huge value creating exercises, and that when you understand that the potential to create value isn't a limited thing when you get started. It's something that's dynamic. You can increase it or you can lower it, based on the inputs that you bring to the table. And that as a client, we've gotten better at communicating this to our clients. The only thing you get to keep at the end is the net value created out of the process. Like, you don't get to keep a small bill. You get to pay a small bill. The only thing you actually get to keep is net value. And so if you bring to the table a team that helps you create more value, I promise you, the net return, just as you pointed out earlier, Pat, the net return is going to be well worth it. And you bring the wrong team, part of the problem is you don't get do-overs. You get to do it once. And if you pick a team that's, just not wired to create as much value for you, yeah, they're just not going to do it. I mean, you look for people like like Pat, that are high integrity people, have a lot of experience, really try to align with their clients' values and priorities. I mean, you're going to have pretty good results, and you're going to know in the process whether or not it's a good relationship fit. Because if there's not a good relationship fit there, or you can't trust your advisor, or they're not responsive, those should be really big warning signs that they're not there to, in the same way that you might need them to be to help you create value. But, picking for cost is usually not a good way to pick for value. But yeah, I'd love to hear your thoughts, Jacob.
Yeah, I mean, I think it's, because obviously I'm not an attorney, but I'm a business owner. I've, purchased a business. I've helped sell a couple companies and everything, but it's all about, the relationships that you build. And,
Mhm.
it's like you were saying, Pat, it's like having an options, have optionality when it comes to attorneys, CPAs,
Mhm.
financial advisors, what have you, but it's surrounding yourself with knowledgeable people that will give you honest answers, not the Midwest nice answers of, those things, but actually tell you
This is the most
straight.
beautiful business I've ever seen.
Yeah.
Yeah.
But it's like the constructive criticism. And,
Yeah.
that's one thing that shocks me when I talk to business owners. I'm like, well, hey, who's your banker? And they probably can't even tell you. They know they bank somewhere, but they can't tell you who their banking relationship is, who the person they can call to get something, or even their CPA. They have somebody that does their taxes at the year. And I'm talking more smaller companies in this regard, but it's like that's so critical. And you're preparing, if say eventually you want to sell your business, that eventually something's going to happen to your business. Either one, you're going to sell it, it's going to close its doors, or you're going to pass away and it's going to come with you. There's going to be a transaction of some sort coming in your
Mhm.
business, whether it be one of those ones, or if you want to really maximize the value, it's have those relationships, have that bench of people you can rely on. So when it comes time to start that process, you can say, yep, I got my people ready to go, and doing that. And I just think it just goes back to relationships and making sure you have relationships that go beyond just the people in your company, but who's out there to support your company as you grow and as you scale and as you potentially may have an exit one day.
100%.
Yep. Pat, we've got a couple of audience questions. Can I throw a few at you?
Please, yeah.
Awesome. So this one comes from Luke Paetzold. What are the top three unforced errors that you've seen folks make that have helped or that have resulted in killing a deal at the 11th hour?
I'm gonna I want to talk a little on the sell side, and then maybe the buy side, right? Because each can sort of kill it. So one would be, I don't know if it's the 11th hour, but not being prepared for the diligence
Mm,
process is a problem.
yeah.
Um, and let me give a little more context to that. I think with professional buyers, they understand these people are in the business of assembling, disassembling, reviewing, supplementing, organizing data
Mm-hmm.
When you think about buying a company, it used to be, remember, this might have been before your time, guys, but when I started practicing, you would fly to these places and they had all the documents and paper, and you had to like look through them, and whether it was financial, legal, the entire company. When you sell, you have to basically package your entire company in that fashion.
Mm-hmm.
And the data room sounds really boring and all that stuff, and it is. But what people should understand is you don't have to have perfection in that, but you have got to be organized. And you've got to have somebody, and it shouldn't probably be you, who can put that together, because your inability to basic organization within folders and to lay out to somebody who has no familiarity with your business and systematize it, you will get penalized for that.
Mm-hmm.
Because they will go, if you can't put together a data room, as an example, or you can't get the right people to help me to organize this in a linear fashion when I'm going to spend millions of dollars. That's easy in the scheme of it. What about all the other stuff?
Mm-hmm.
How would I possibly understand, or more importantly, be able to validate and have trust in your financials and so forth?
Yeah.
So organization blows deals. You get under a letter of intent, you get into the middle of it, and you just are unwilling. You're just responding to information. It's incomplete, whatever. That matters, right? And so that's one thing where I've seen deals kind of blow up in a pure admin side of things. The second thing is letter of intent. You got to get it right. You just have to get it right. If you don't get it right and you come in with this generalist idea, which is what most people have, and you all research things on Google and you get enough information where it says it's general, it's non-binding, I can run it through Chat GPT or whatever. All my ability to have leverage and I'm just the attorney. Same thing with your investment banker, goes bye-bye if you're not thinking about kind of the strategic angles we've talked about. So the reason why things can fail is oftentimes you get yourself under a letter of intent, then you get into the deal and you start learning my rollover equity is really not worth that much. It's just kind of a glorified bonus to keep me there. The earnout is a complete pipe dream. Once the buyer started putting all the particulars around it, I didn't realize they're going to hold back several $1 million of my money. Those things kill deals. Now I want to like throw some ample shade at buyers, right? Because I typically deal on both sides, but I would say by and large, I'm kind of a founder's lower mid-market and mid-market M&A advisor. On the buy side, Sam, you'll appreciate this. I mean, trying to use no customization and having no meaningful dialogue with your attorneys, even if they're, Ivy League bred and they work for these huge firms, not understanding like, hey, this guy sells an IP company. Let's lay off on all the environmental reps and all this other bull crap because this seller has enough to get through in the first place. And also understanding like, look, there are things that are market and there are things that are standard, and none of us reinvent the wheel. Of course, every attorney starts with a form, but a really good one and really good advisor is going to. It's like if you took a big, slab of beef, like in the Rocky movies, when he's punching too many people take that big slab of beef on the buy side. And I'm talking about professional buyers, by the way.
Yeah.
You take this big slab of beef, and what you need to do is you need to take that slab of beef, you need to be cutting at the beginning, all that fat off. Boom, 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 boom. So when I deliver it to Jacob, and I know Jacob is an Orange Theory guy, and I know that the way he thinks, he's into fitness. He probably did his company in this fashion, whatever. Like, yes, I protected myself. I've still gotten all the same outcomes, but I delivered him a product where the tension went down, right? So buyers blow up deals by not lowering the tension and thinking they're smarter than absolutely everybody. Never thinking like an entrepreneur and not being able, as I put it, to traverse between the world of institutions and founders. And by the way, founders that you're going to have a partnership with. So when you had a conversation with Jacob and you said, Jacob, we want you to roll $8 million of your hard-earned proceeds, and we're going to triple that because, you know, we're the Blackstone. Well, Blackstone would be like, but you get the point, right? We're going to triple that money for you, and you're going to get to invest at the same level, and this, that, and the other. Then don't show up because your first-year associate just threw everything on the shelf in their form base and completely derail that little detail, like $8 million, and then definitely don't come back and then say, well, that's just what my lawyer tells me and whatever. And no, you need to think for yourself. You guys have Harvard MBAs, whatever the case is. You have Six Sigma stuff. You need to be able to have adult conversations. I have them all the time with my clients. We are always, always, always more prepared at the end of the day. And the reason why we're more prepared is communication. So where do buyers blow it up? Buyers oftentimes are poor communicators and they rely on their numerical expertise. So that is, I can't even tell you how important that is. I've dealt with so many PEs and lawyers and whatever, and these people, their IQs are probably 10x mine from a natural standpoint, but they just have not learned the art of what I just kind of explained. Right? So that to me is where buyers fail.
Yeah. I mean, I'd echo that real quickly, and then we got one more audience question. But I mean, we've had a client that unfortunately has seen that cycle repeated a couple of times with prospective PE buyers, where they come in and then they don't lay out all the details in the LOI, all the important ones, and then they come back, or they try to change them afterwards. And you just destroy trust. I mean, you're asking somebody to trust you with this significant amount of post-closing consideration while simultaneously changing the deal terms with no articulable reason other than, well, we think it's good for you. We think it's good for everybody. Like, say exactly what you want at the front end. Know who you're dealing with, and don't just run a playbook. I mean, you're dealing with people.
I mean, that's
and if you destroy the trust, I mean, you're going to destroy the deal. Because I'm going to tell my clients every single time, if you don't trust somebody, don't do a deal with them unless you've got literally no other options.
I'll just
I
echo
think
that.
a lot of buyers are not. A lot of times they think, and this is true. They oftentimes the seller hasn't been through the same process. They're banking that the seller is not as sophisticated as them, and a lot of times, and they get away with certain things, and so they're just going to have these sales conversations in effect, but not stand behind certain things. And at some point, you can't just blame a document or whatever. Sometimes you have to like stand behind things, and you're 100% right. And I want to be clear, while I will represent a buyer differently than a seller, I am a general proponent of being completely honest about what the if for example, this rollover equity structure on structure, big money, people rolling big money, but it's tied to employment and they can pull it back, treat it like it's a profits interest subject to vesting or something like that, has gotten out of control. That used to happen on really small deals. Now it's happened on larger deals. At least come to the table when you're doing a letter of intent and go, well, let me tell you a little bit about our rollover equity. You do have to be employed. And if you're not employed, here's what happens. If you don't do that, and you just have something, I'm using an example I'm in the middle of when I keep going back to this 8 million. If you just if my client shows up to me and I haven't been involved and I see that there, don't think this has nothing to do with legal. Don't think that I'm not going to call you on that.
Yeah.
And don't think that I'm not going to bring in, if I need to, the managing partner of the entire private equity firm and say in very brass tacks basic language, when is the last time you took the functional equivalent of $8 million of your property in cash or anything, and you treated it like this, or you would ever treat it like this? Because the answer to that question is never. And if somebody is well advised, like that conversation is coming, and
100%.
there is no way you can talk in circles around
Right.
them.
Right. Yeah. And if they're well represented, that conversation is coming. And that's why, how you pick your team is so critical, because especially as you get into these more complicated deal structures, there are providers that unfortunately, who haven't seen this stuff before are going to get into it and just make the reach the conclusion that, hey, this is just how this stuff always is. You just need to agree to it because this is how it always is, without really understanding how it is and how you can push back and stuff. And but one
By the
last
way, this isn't to undermine the relational elements here. I believe
Yeah.
relationships are critically important, and there's a time and a place.
Yep.
You don't have this conversation the first day.
Sure.
But I'm a big believer in partnerships that have or haven't worked, even in my own business. When I really go back to the core of why it didn't work, typically it was because we didn't have the same information or understanding from the get. And maybe there was a fear of getting to the bottom of that. And it's kind of like a marriage. I mean, 50% of marriages end. You should be willing at a certain point in time to be mature enough to go, maybe we need to talk about some of the real details to make sure that, yep,
Yeah.
let's take the next step or not. It's no different when it comes to this, right? And I think the challenge in what we're talking about right now, it's completely psychological. We're all uncomfortable about having uncomfortable conversations.
Yeah.
This is where, by the way, your advisor matters a ton. I do some investing and stuff, early stage investing on my own, and I've made some massively poor decisions. When I did make those massively poor decisions was because I was not thinking objectively in the same manner. I wasn't approaching it like I am right now, because I was afraid. I was afraid of and because I didn't have somebody who was keeping me on the straight and narrow, right? And that's what I think, again, coming back to the advisor thing. And that doesn't mean creating a perfect deal. There's no perfect deal. And sometimes, by the way, Sam, you also need that advisor to tell you when you're digging in too hard.
Yep.
Sometimes I have to tell my clients, like, you're digging in too hard on this.
Yeah. No, 100%.
Go back.
100%. Well, Pat, we're really grateful for your time and sharing your wisdom and your experience with our audience. Just to kind of wrap us up, we've got two last quick questions for you. What's one great tip that you'd like to leave buyers with, and one great tip for sellers?
Buyers, treat it, if you want a significant financial outcome, because in some instances, maybe you just want to hand the business off, or maybe selling a business isn't your objective. But if you want to sell a business with a life-changing outcome, you got to prepare early, which we've talked about ad nauseum, and you have to process it, I believe, in this way. Buyers, it's hard. It's a competitive market out there to find quality businesses and all that. The one thing I would say about buyers is lead with intentionality. Intentionality wins. In the types of deals that we're talking about, there's a partnership relationship that exists 90% of the time, and partnerships are typically, the best foundation is set with honesty and integrity on the front end. That means specificity. That means standing behind your word. That'd be kind of
it's interesting. It's emotional intelligence, and everybody wants to preach IQ and be the smartest person in the room, but it really boils down to just to be a good person and lead with intentionality. That's so critical.
Yeah. Well, Pat, thank you so much for joining us today. We're really passionate about partnering with our listeners to build the businesses and help them transition in ways that build thriving local communities. And this kind of information is just absolutely critical for that. And we're really grateful that you've taken time to share with us today.
Yeah.
This is awesome, guys. I appreciated you having me on. Let's stay in touch, and thank you.
Appreciate it.
Thank
Have
you.
a good one. Thanks.
Thank you for joining us today. For future episodes, please subscribe to the podcast on Apple Podcasts or Spotify. And please check out our website at www.goforemanlaw.com/learning.